This conference will now be recorded.
Very good evening to all of you present for the session today. Okay, so yesterday we had put up the Volvo case study, right? So I hope all of you are ready. Tell your friends to join immediately. So open that Volvo workbook which we were solving yesterday. Open that Excel file where we have that Volvo case study. So keep this file open now. Yes, hope all of you have opened that file. Shall we start? Are you ready? Shall we start? Shall we begin the solving the file? Fine. So, in the last class, yes, we had solved till here, right? We had calculated the depreciation. To be frank, let me come from the first. Okay, we had calculated the revenue, total revenue generated for all the years. Then the fuel cost, what was incurred for every year, maintenance expenses, driver's costs, miscellaneous costs, the total charges. So we summed up all the expenses. Okay, we are getting for year one 62 lakh 60 no, 72,890, then 7 lakh 38,624, 79 lakh 19,217, 89 lakh 31,900. Okay, so then we arrive at the GP, your gross profit. Okay, and here EBIT, your GP is nothing but earnings before interest, tax, and depreciation. So how do we arrive at that? We arrive at the revenue minus your cost of revenues. Okay, and after that we are calculating the we are what do you say subtracting the depreciation part from the GP to arrive at the EBIT, earnings before interest and tax. Your depreciation, you know how we have done. Yeah, it is the value of the vehicle, 75 lakhs into the rate of depreciation. So we get 18 lakhs 75,000 as a depreciation. Then followed by the interest expenses. For the first year we had marked, and after that we had to complete the interest expenses. Okay, so let's go on. Now, to get the interest expenses for the rest of the years, we have to go to the debt schedule. We have to solve the debt schedule and then transfer that amount from the debt schedule to the income statement. So let's come to this debt schedule. Please come to the debt schedule at the bottom here. So here in this debt schedule, okay, from year zero, right? So here now at the what do you say? Now we have to start from the zero year. Yes or no? Now here in the year zero, what is our opening debt? Now, as I've told you, out of 75 lakhs loan, okay, sorry, 75 lakhs cost of the bus, 75% has been approved from the bank to provide loan. So, which means 75% of 75 lakh will give you 56 lakh 25,000. So, in my year zero, my debt amount is 56 lakh 25,000. Okay, so equals to 56 lakh 25,000. Okay. Next, in the year one, again, because see, EOP means end of the period, BOP means beginning of the period. So I'll repeat again. BOP is beginning of the period, EOP is end of the period. I've already explained in the initial classes of your FM. EAI means easy annual installments. EMI is equated or equal monthly installments. In the same way, EAI is easy annual installments. Okay. So here now end of the year zero, if my debt is 56 lakh 25,000, that debt becomes the debt for the beginning of the next year. Yes, so closing balance of the last year becomes the opening balance of the next year. Okay, so equals to this enter. Okay, so take this cell reference for year one. Then you're going to calculate the EAI. Remember, you had done EAI for debt amortization schedules and so many cases. Same procedure equals to PMT. Okay, so you start with the rate. Now, what is the rate here? Rate is this one. Okay, 15%. Your rate of the loan is 15%. Okay, comma. Next is what? It is number of years. Number of years is below only. It is 4 years. Okay, comma. Next is present value. What is present value? Okay, so what is the present value of the loan? It is this. This is the loan amount. Okay, comma. Future value there's nothing, and it is always at the end of the period. So you press enter, you get an amount of 19 lakh 70,000 243 rupees. Okay, for the first year you're repaying so much. And not only for the first year, the debt repayment is uniform for all the years. So what you're going to do is, what is your EMI? EMI, EAI, almost the same base they have. Same amount you're going to pay every month to clear your debt. Okay. So I'll repeat this EAI again. Please focus. Equals to PMT, payment. First is the rate. So your rate is 15%, comma, number of years. Number of years is 4 years, comma, present value is your loan amount, comma, there is no future value which we are arriving at, and this is all calculated and paid at the end of the period, so it is 0. And shift key, close the brackets and press enter. So you get this amount. Now this amount of 19 lakh 70,243 is paid every year to clear the loan of 56 lakh 25,000. Okay. So here if I am going to drag clear, what happens? You get like this, which you're already aware of. So what you're supposed to do here is you're going to freeze all the cells now. See, I'm taking here. I'll press F4. I'll freeze H. Again, I'll freeze H9. Again, I'll freeze N7. I press Enter. And now if I'm going to drag, I get the same value. Okay, so just double click on the cell of EAI. You can just see this and complete your calculations. Then I'll move forward. So I've left it as it is. So you can just observe this and do the calculation of the EAI and drag it for all the 4 years. Please do it. Have you finished doing? Are you done with the calculation of the EAI? Yeah, very good. Yes, ma'am. So here, see, this is how we're going to get. Now, this is your EAI. Now, interest expense, how do you calculate it? Equals to, how do you calculate the interest expense? Your loan amount into the interest rate. So, what is your loan amount? This is your loan amount. And now you can do one thing. You can select this or you can select how you used to do it earlier. I'll take you in that way. Your loan amount is this, correct? Your debt loan into what is the interest? Interest on debt is 15%. So you should be able to get 8,43,750. Okay, so your debt, your loan amount into the interest rate, N7 into H8. Okay. So like this, you're going to get the interest expenses. Press enter. Now, what is the principal repaid equals to you remember you have done your debt amortization schedule, say same only this. Your principal repaid is what? Your EAI minus interest. Because your EAI will consider principal repaid plus interest. So what I'm going to do is from the EAI, if I subtract the interest, I will get how much principal I have repaid for the first year out of 56 lakh 25,000. Okay, so here what you're going to do is principal repaid is your EAI will come. So this actually what you're supposed to do is now since it actually EMI is a minus figure, but since here if you have to do remember I taught you that when you're doing this here you have to be a bit careful. Now N7 is what you've put as a present value. So there, if you put a minus sign, you can just remove those brackets. It is subject to subtraction, but think if this is a minus figure, this is also be a minus. It means it become plus here. So what you're supposed to do here is, okay, just double click on the cell, and for this N7, that is your amount, your loan amount, your debt amount. This one, we're just going to put minus before, minus sign because you have put here so minus sign. And if you press enter, then you'll get the amount with no brackets. Now you can easily calculate the principal repaid equals to EAI minus interest. So you get this much. Okay. And then what is the closing balance in the year one equals to your opening balance minus your principal repaid. Press enter, you get this much for the year one. So complete the calculations for the year one, then we go to the year two. Yes, are you done? Have you finished doing it for the first year? Okay. So we'll go for the next one. Okay, now for the year two, what happens? Equals to same thing, same procedure. To the cell reference. Again, calculate the interest expenses equals to your loan amount into rate of the, uh, rate of interest. Okay, you get interest expense of 6,74,776. So what is the principal rebate equals to your EMI or EAI minus interest. Okay, equals to BOP, beginning of the period, minus principal rebate. So we're going to get 3 lakh, 32 lakh, 3,041 equals to again carry forward equals to loan amount into again 15%. Minus equals to reading of the loan minus principal rebate. Again interest. Take the loan amount into again 15%. So your principal rebate is this minus EAI minus interest. So we are done. So equals to closing balances minus principal rebate. So really easy. Oh. So please finish off the debt schedule. Yes, have you finished off the debt schedule? Or still you're doing? If you're working, you let me know. Have all of you finished? So this is still someone working for the debt schedule? No? In case if you're working, you can put up in the chat box. Fine. So then I'll move ahead with the income statement, the remaining parts. Fine. Now you have completed your debt schedule. Now, is the debt schedule clear for you? Anyways, you've worked, you've got the experience of working earlier also. So when you completed the debt schedule, is it clear for you? Or do you have any doubts over there? Fine. So we'll just proceed from there. So now we have completed this debt schedule. Now here we have to put up all the interest expenses from this table to this table. Okay, now first years we already put up 8,43,750, and for the rest of the years, okay. So for the rest of the years, we are supposed to calculate the debt schedule, right? So you're going to transfer the amount. Okay, so what you're going to do now is you're going to put up that amount from there, that table to this table. See, equals to, take the cell reference here, enter, like this. Now we are going to arrive at the PBT, which is your profit before tax. Of course, as of now, we get a different amount. Okay, but that's fine. So your PBT is what? We have to arrive now. So your GB is this one, 26 lakh is 10,610. And now you have to arrive at your PBT. Nothing but gross profit, depreciation minus interest expenses. Minus is the sum of both. So if you do like this, consider, we'll see. Make a try. Yes, you can do in the same way. So here how I've done. Because otherwise you have to calculate the sum of depreciation and the interest, and then you know subtract it from the gross profit. It's directly you can do it. No issues. I'll repeat again. PPT equals to gross profit minus your expenses. So in the whole, put on the brackets, depreciation plus interest expenses, close brackets, 49,140. This is the amount you're going to get as PBT. Okay, and since what has come, we have got a negative figure, 49,140. So it's a loss which has happened in year one. So when there is a loss, we cannot have any income tax calculation. So it will be zero. Okay. Yeah, Shruti, what happened? Are you wait? Shruti Raghuveer, are you there? Yes, ma'am. Yeah, one second. It's coming as waiting. No, I'm not able to find Shruti Raghuveer here as waiting. Otherwise, I can just consider the entry. Please inform Shruti Raghuveer to log in. I've already put up in the WhatsApp group. So you can just try again logging in. It'll be logged in. It's not like something I have to admit you. It's possible. I think it is going on and off, Shruti. Yes. So let's continue with the table. So now, since in the first year we have a loss, okay, we will not calculate the taxes. It will be zero itself. Okay. So what you're supposed to do here is first you are going to have the PAT. What is your PAT? Your PBT minus tax, income tax. So PBT minus your income tax. So same amount you're going to get. Okay. Now again for year two also the same procedure you have equals to your GP minus depreciation plus interest expense. Shift key close the brackets. Okay, so your IT is what? Your income tax. What is the amount we've got here? Your income tax is 5%. Tax rates it's been given you as 5%. So income taxes equals to your PBT into 5%. So to get an amount as such, okay, and then arrive at the PAT equals to PBT minus income tax. Okay, next. Same procedure equals to PVG equals to GP minus in the brackets this plus this. Equals to like this. You have to complete the table. So please finish up this table, income statement, and then you go for the balance sheet calculations.
Ma'am, income taxes the first year we don't consider.
No, but we cannot consider income tax for the first year. Why? Because in the year one, there is a loss, right? 49,140. So now for the loss, we cannot calculate the income tax.
Okay, ma'am.
Yes, have you completed the income statement? Is it over? Fine. So now we'll proceed with the table. So we have arrived at the PAT here, right? So now we step down to the balance sheet. Fine. So slowly we'll move to the balance sheet. Okay, now cash calculation will be done later. Because you have to complete the cash flow statement and then we have to arrive at the closing balance of the cash. Okay. So first we are going to put up the balance sheet. Now here,
Ma'am, your screen is not visible.
screen is not visible.
Now it is.
Huh. Yes, ma'am. Once again, I'll just refresh the screen. Once again. Yes, ma'am. So here, yes. So now in your balance sheet, now first is what you have. You have to update your closing balance of your cash, which is going to be done after we resolve the cash flow statement. So first we are going to start with the other items to be entered on the assets. Okay, now cash we're going to leave it blank. Now cash for the first year it will be zero, year zero. Okay, the zero balance of cash. So here you're going to put up as 0. And again, now PPE means what? I've already taught you. Property, plant, equipment, your asset. So what is the gross value of your asset? The gross value of the asset is what? Equals to 75 lakhs. This is the gross value of the asset. Okay. Now, the gross value of the asset remains the same for all the 4 years. Will it change? It won't change. Okay, at what value we have acquired the asset, that value will remain constant over the period of time. It will not change. Post depreciation, we might observe changes, but the gross value will remain the same irrespective of the period. So now this one from year 0 to year 4, the value will be the same. Now how in your examination, in your balance sheet on the asset side, you calculate, right? From the value of the asset, you calculate the depreciation, then you arrive at the net value, net amount. So the gross value, will it change? No, it would have been purchased years back. So that value remains the same. The historical cost is what we define. So here also the same concept applies where the gross value of the asset, okay, remains the same for all the for all the years. So what you're going to do is, now in case if I drag from year 0 to year 4, it will appear in this way, which is wrong. So as I've taught you, you're going to freeze this cell. Okay, just freeze the cell by using F4. Yes, it has been freezed and now you can drag from year 0 to year 4. Okay, like this. Next, depreciation. Now for year 0, we don't have any depreciation, it is 0, right? Because here also if you observe, yes, coming, sorry, here. Yes, we only start from year 1. You don't have anything to consider for year 0. And now you arrive at the net amount of the property, plant and equipment. So how do you arrive? Equals to gross value minus depreciation. And come to the total assets equals to complete cash. We have to be careful if not at all because depreciation is not an asset. So cash plus your net value of the asset. That's how you're going to calculate because depreciation is a non-operating expenditure. It is not an asset. I'll repeat again. Your total assets you should consider only the cash, that is this, plus your net value of the asset post depreciation. Okay, this much. Now for the next year, again, you have the cash balance here, which will come up later. Again, depreciation. Okay, so depreciation, how you're going to put equals to what is for year one, what depreciation we've got, this one. So take the cell referencing E33 and press enter, and then calculate the gross value, net value of the asset equals to 75 lakhs minus your depreciation, enter. So you get the net value of the asset again equals to your cash, include that cash though it is an empty cell, include that plus, because afterwards when it comes into picture your values will change. Press enter. Okay, now it will be like this, but once your closing balance of your cash appears in that empty cell, when it gets filled up your values will automatically change. So you have to consider that empty cell of cash and calculate the total assets. The same thing here equals to what's the depreciation again for the next for this year. So how you used to calculate now? If you remember your old tables which you had done, whenever we are doing the accumulated depreciation, how we used to do, tell me. One of you can answer. Yes. Now this, okay, which we have taken this plus this. Okay. One second, wait. Now this I have done. Now I have to go for year one. Now year one is my answer. I want to ask you, do I need to add something or is it correct? Now year one, I have taken depreciation as considering this reference cell depreciation. Correct. Okay, now do I need to add something to that or is that correct? Very good, Christina. We have to add the previous year's depreciation. Very good. Right? So here, now see, 18 lakh 75,000 is right. Yes, the current years. Okay. Plus my previous year, which is this your first year 0. Though it is 0, still we have to consider. In the same way, equals to your current year's depreciation. Now for year 2, okay, we are in the year 2 itself. Now the current year is this plus your previous years. So it should come up to 37 lakh 50,000. Okay. So what is the net amount? Equals to gross minus net. Again, I told you, right? Cash sell plus your net value of your asset. Okay. So again, the same procedure equals to current year depreciation plus your previous year depreciation. net value of the asset equals to gross value minus net value. Okay, so equals to cash sell plus net value of the asset. Again for year 4, equals to current year depreciation plus previous year's depreciation equals to gross minus net. Gross minus your depreciation, arrive at the net value equals to your cash plus. So like this, you're going to arrive of your which side? Your asset side. So quickly finish it off and then move on to the liabilities part. Have you done with the asset side, all of you? Have you completed? Good. Now I'll go to the liability side. Okay. Now so far you've been doing the debt schedule, completed the income statement, did the liability side, sorry, asset side of the balance sheet till here. Any confusions are there or everything is clear? As I told you, this is a big case study which you're doing. So going deeper, deeper, deeper in your FM. So if you have no doubts, then I'll proceed with the liability side. Fine. So let's start. Right. So you come to the liability side. It's very easy. Because see, already everything we have now. Debt we have, equity we have, retained profit we don't have, we need to do it. Again, that's a missing figure which we have to fill it up at the last. Okay. Now see, coming to the liability side, you have to be a bit careful here. Now, in the year zero, what is the loan amount we have taken? It is 56 lakh 25,000. Okay, so you can take this reference at the big. This is at the end of the year. So best is this. So this is one which you have to take, or like every time you have to be choosing it. So we have to be calculating it. So in simple terms, if I have to tell, now, in the year zero, what is the loan amount at the end of the period? Is what we have to consider always. Not at the beginning of the period, but at the end. Because balance sheet is always giving values for us at the end of the period. Yes? So, what is the loan amount at the end of the period of year zero? It is this. So, I press enter. Again, for year one, again give the reference. Okay, again for year 2 equals to, so we have done with the debt. Now coming to your equity is constant throughout the year, it will not change for us. So you can freeze the equity cell equals to your equity calculation. So your equity we have done. Yeah, above we have the equity parts here. We have 75% of debt, we have 25% of equity. So here you're supposed to do it. Okay, so equity is 25%. So this into 25%. So what would be the answer for us? This is okay. So 75% if it is sanctioned by loan, remaining 25% is by raising equity shares. No, so total value into 25%. Now this again same thing. See if you're going to pull up for all the years, you won't get the values. So as usual, you have to freeze here. Okay. So press F4 on both the ends. And now you can take it for all the years. Okay. Fine. So now, how is your retained profit calculated? I'll tell you. Now, for the year zero, it will be nothing because year zero we don't have any profits to add. It will be zero. Now, for year one onwards, carefully observe equals to year zero. It just works like your accumulated depreciation, your retained profit, previous year plus current year's profit. Okay. I'll repeat again. Your retained profit works like your accumulated depreciation. We consider the previous year's with the current year's. So previous year's profit with the current year profit. Now for year 1, if we have to take year 0 plus, we are going to take year's 1 PAT. That is this. So you get this value. Again for year 2 equals to year 1 plus year 2's. So again, as I told you, you'll have a change in this value once we arrive at the net amount of cash. Again, equals to this amount plus this. Again, equals to previous year plus current year's PAT. Okay, and now you arrive at your total liabilities equals to the total liabilities is what? You should not consider here retained profit, right? So your liability structure completely you should not. But as of now, you can just put up, okay, the sum, okay. Because after you finish your CFS and you get your end of the period cash, that will be put up here, and then we can fill up all these details here. Until then, you have to be patient. Okay. So till here you arrive. Total liabilities, we will calculate it later. Okay. So considering your other figures, so you can also do not automation. You can calculate the sum, but afterwards we have to make changes. Okay. So you can do and you can complete it. So you get like this. Same thing goes for the rest. So it's the sum of all your things, debt, equity, and your retained. They will be treated. So complete your liability side, and then we will do your CFS tomorrow. That's the crucial part. If you want to repeat again the total liability side, just add up, just do the sum. That's all. Afterwards, we'll make up the changes. If that equals to sum, all the three cells, all the three cells. That's it. Do it and drag it for the rest of the years. So that will complete your liability structure in your balance sheet. Because tomorrow, as usual, CFS and the other structures, and finally we'll arrive at your IRR, internal rate of return, to check the piece of project investment. Can you invest in this project or no? So have you completed? Are you done with the liability part? Okay, so till here you can save your file. So tomorrow, as I told you, we are going to resume to completing your Volvo case study with your CFS at the beginning stage. Okay, so see you in the next class.